Goodinvestors.com Thursday, everybody. How are you? Yes, the webinar has now started. Everyone doing okay? Let's have a great day. Who's up for it? Who's ready to rumble? Are you ready to rumble? Okay. Everything's cool. All right. Good. We have some action junkies in here. Who's an action junkie? Give me a Y. Who went to their FA meeting this week? Anyone know what FA is? Forex Anonymous meeting? Anyone go? You better get to your meeting, Ariel. All right, so I'm taking a shot here in the Dixie to the short side. Okay, I know that we're on the verge of breaking out here back over 101. I'm even giving a little tolerance in case we probe it for stops, but just my thinking is that what we have here is, kind of like this isn't a 3 drive to a top because it's not happening at highs, right? But there's still a sequence of 3. So here was the first attempt at 40. Here was a stop hunt above the prior high. Little pullback again, another stop hunt after people figured, dollar bears thought they had it, and here we are again. I'd say they took out some buy stops over this level. Yeah, I don't blame you. And you can't breathe. It's hard to give your testimony, Zig. I know what you mean. So, tight risk trade. If this ends up being a failure, one of the reasons, like every day, Yash, we go 90 minutes, and the first 60 minutes is the team sharing their analysis. Okay. No straying bar. And then the last half hour, we have a guest interview. Today it's David Keller, who is one of the big shots at stockcharts.com, if you're familiar with it. Yeah. Well, so far you're right, FX trader, dollar heading up. Do you, Joe? It's a great guy. Anyway, David's going to be with us today, so stick around for that. Looking around, another reason I think that we might have a pullback in the dollar is, what's the gold waiting for here? I mean, how many times have we knocked on the door of this breakout of this triangle here? All right. And something I noticed, and I still think we could and we will break out for a terminal thrust if this is a 4, the next wave's a 5. But, when gold was railing yesterday, silver began to struggle. I believe that silver is still going to be the preferred short. I'm going to let gold break out and then look for a short in silver. And the reason for that is, look at where this gold-silver ratio held. Oh, you subscribed? All right. Welcome to our community. Okay, I won't be fooled. I wasn't fooled in the S&P on Tuesday, was I, Gotham? So anyway, I do get fooled, and I could get fooled again, but I'm not going to be fooled to make the gold my preferred short with the gold-silver ratio holding support. Yeah, we'll see. I'll get to TLT in a minute, Jet. But the way we're holding right here tells me that there could be another wave to the upside. And if that's going to happen, we never quite got to 118, 120. If we're going up, just like EG, if EG is going up, what's your preferred long? That's right, euro. If XAU, XAG is going up. What's your preferred long? That's right, gold. So I think that we could get a decent rally here before we fail. Maybe this is, A, B, C. Maybe this whole thing was A, I don't know, or 1. Anyway, I don't know, Elliot, but I think that we could rally back one more time, and that's going to make silver the preferred short. Here's Newmont. I mean, look at this divergence here. Could squeeze again one more time, and this has been the strength. The shares have been leading the way. Here's GDX. It looks like we have a 1 and we have a 2 and we need one more. Okay. Well, not always, maybe recently. Some pretty good input this morning. So here's TLT. Really had to be patient. So we've had 2 days of risk off, right? S&Ps have gotten clocked pretty good, right, from Tuesday, over 100 handles. And this is the bounce in TLT. S&Ps are lower again today, so we'll see what TLT could do. You have some support right here at the 64 level. But so far, I'm not impressed, and unless the S&Ps turn out to be a complete rout, I'm still not impressed with this. And let's see, what else do we want to talk about? I am constructive on the yen, and despite risk off yesterday and today, yen is acting respectably. So far, it's held this a little bit above 61.8. I think it looks okay. So, I'm thinking that this was the first wave up. Okay, so yen looks good. Okay, thanks for agreeing with me. Blake, good morning, buddy. Some risk off this morning in S&P's pretty negative week. What are the implications for FX with what's happening here?
Hey, Coach.
Hey, buddy.
Well, first and foremost, it's been a fairly quiet night overnight. The one of the reasons why the equity markets are we're at our lows currently is that on Fox Business, Trump is talking. So he's making a lot of remarks about China, like, what if we cut ties with China? President Xi and I are friends, but I don't feel like talking to him. He's making comments like that. So it's I think it's freaked out the futures a little bit. Futures are coming down, but the currency market's actually quite, I guess you can say, consolidative. So let's, I guess we can start off by looking at the euro. But I would be a little cautious about being short the euro down here. I am bearish the euro, but as I have told you guys for weeks. But when you're down here at support, it's like, okay, well, is today the day that it's going to break lower? Is today the reason why I need to be short the euro right now at this moment in time, considering that it's been here how many times since February and it's held? Give me a reason that I need to be short at this very moment. Like, you can come to me with a thesis and say, well, the euro should be lower because it's just the Eurozone project and it's going to hell in a handbasket and blah, blah, blah. You can give me all your reasonings, but do you really need to be short at this very moment? Is there a reason at this very moment you want to be short? I'll tell you one thing that would worry me. Futures continue to break new lows, but the dollar's not hitting highs. That right there would tell me, okay, I got to be a little careful being short the euro down here. Right. So anyway, so here we are. We're at support, or what could be construed as support somewhere down here. And actually, if you want to get really a little nitpicky with me, you can probably do this. find a little trend line down here. I mean, I'd be a little nervous being on the short side of the euro. As a matter of fact, when you look around, let's take a look at this for a second. When you look at around at the euro pairs, so here's the euro yen. The euro yen just hit the 618 retracement overnight, or really damn close to. Again, stocks are selling off. Euro yen stopped selling off the last
great point
8 hours.
Mm-hmm.
Okay, so I'm just showing you other euro pairs.
The wizard likes this too, thinks that we bottomed.
Maybe, and the yen's a very I think the yen is a tricky animal now, and I'm not treating the yen quite like I used to. Although I do think that if the market implodes, we start to see some serious risk off. The yen's probably going to catch a bid to a certain extent, right? But I'm not expecting the stock market to implode either. We could grind lower, but which I think we will. But I don't think the yen's going to come into demand like you saw before. All right. So anyway, here's the euro yen. Let's take a look at other euro pairs. Here's the euro pound. Now the euro pound, you guys know, is at range resistance, held the 618 overnight. You can see it right here. Held the 618 overnight and is bouncing. Again, you think about, do I really want to be short the euro dollar right now? I'm showing you other euro crosses. Euro Aussie. I'm very bullish the euro Aussie after last night's Australian jobs report. Still have every reason in the world to continue to be bullish the euro Aussie. Euro Aussie. Looks like we're going to 169 as we eventually make our way up to 169.50 or 170, whatever, wherever we're going. Okay. Again, you're telling me right now I should be shorting the euro. I'm just showing you other euro crosses. Here's the euro Aussie. Here's the euro Kiwi. Now the euro Kiwi is at channel resistance. However, if this thing breaks out, we get above this 50-day moving average, we're going to trade above 184 probably. Again, you guys
Great point, Blake. So for people that are newer, what Blake is showing is the euro showing relative strength in all these crosses, except maybe against the dollar.
Yeah. I mean,
right?
Again, I'll say again, I'm bearish the euro, but I'm not necessarily bearish at this level. And then on top of it, you got stocks selling off, yet the euro is not selling off. The euro is done selling off, at least intraday. Then, you have the euro Swiss, which is at really key support. And they are defending this pair. Very similar to when they were defending the 120 level. The backlash that the Swiss National Bank got down here, I doubt they're going to let this one go so easily.
Look at that glaring divergence, Blake. Even if we make new lows, RSI is going to stay well above 30.
They're not going to let it drop below 105, and if it does, it'll go to 104.98, and that'll be it. But yeah, I mean, it is divergent, of course, because they're just holding.
Going back to January was the last confirmed low on that.
Yeah, I mean,
just look at the RSI chart. Yeah, January.
Yeah, I mean, it's been. But this is Swiss National Banks at work here. That's the important thing to know is you're at support here, and it could jam higher just on a little short squeeze. It could jam right up to 105.50, from 105.10. Again, I'm showing you the euro dollar because I'm not necessarily, I'm not sold on being short right here. Not at this very moment in time. Well, I'd like to short the euro maybe closer to 109, like yesterday when we were at the 50% retracement. But again, being short the euro dollar right now, I don't know. Yeah. And so that, that begs the question. So what do you do here in FX? Well, the FX market, I think, is in a consolidation mode today. So you got to be a little bit careful about being too aggressive. I was looking at some of the guys and gals in our chat room about over the last hour and a half or so that I've been awake. And what I realize is people might be getting a little bit aggressive. And when you're in a consolidation phase, like I think we are today, like kind of consolidating, you got to be a little careful. And I don't think that we have a lot of clear-cut direction in the market. Let's talk about some of these other pairs. So here's the pound. Now the pound, as far as the cable goes, as long as we're below this support, 122.50, looks bearish. I mean, we have this big. Whoops, here, let's go to the 4-hour. We have a big head and shoulder, maybe a triangle. So rolling over. Aussie's trying to break through 64. 64 cents has been pretty important. As far as I'm concerned, it's been pretty important support. If you've read the ForexAnalytix basic technical analysis, talked about the importance of 64 cents. And I mean, today's low is 64.09. So, it's hard for me to be too bullish, but at the same time, too bullish, meaning that it's bouncing off 64 cents. So I want to get long as we come through this triangle. But at the same time, again, I watched the stock market being down this morning at lows, and the Aussie dollar is not at lows either, right? Kiwi. So here's the Kiwi, just feels the price action here. Hold on, let me do something else really quick with this Kiwi. So I was kind of following this channel. We're below channel support, but let me do something here. Okay, and let's go to an hourly. Oh, no, I didn't want to do that. Okay, here's your hourly. Watch this, just in case, we get a rip back above 60, because I have a feeling that everybody's bearish the Kiwi now that we broke below 60 cents. Everybody's like, yeah, we're below 60 cents. That was a breakdown point. It's below channel support, a lot of horizontal support, blah, 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 blah. Yeah, I think if we get it back above 60, we're just going to squeeze. So, and this is probably good for a good 20, 30 pips. And sometimes that's all you need, right? Is a 20 or 30 pip move. Just some food for thought. Dollar Canadian's at triangle resistance, right? It's at triangle resistance. And I guess the point I'm trying to make here in most of this analysis is that we're range bound. You know what I mean? And while we're range bound, it's just it's important not to be too directional in the market as we're range bound in the market. One of the other things and let's go take a look at the dollar yen. And the dollar yen, this is one of those pairs that I actually have an order. I canceled it. I had an order to buy the dollar yen overnight at 106.70. What I was hoping for, if you look at this, came out of this descending wedge, is bullish as we came out of the descending wedge. What I was trying to do is buy it just at new lows at the 618. So I wanted it to shake out anybody who was buying it up here, shake them all out, get them out below this low, be on the bid down here at 106.70 at the 618 retracement, and get long. That's what I was hoping for. Obviously, it didn't happen last night. We just didn't. We made as low as 106.77. My bid was at 106.70, so it didn't trip my order. But these are not. I don't think this is a bad level to be long the dollar yen, because equities are going down, yet the dollar yen is holding up. Remember, human behavior is not a flick of a switch, and correlations are not, a flick of a switch either when they go on and off. Since I've been trading currencies, which would be 2002, 2000, late 2001, but basically 2002 is when I stopped trading equities and I started trading currencies full time. Since then, so you're talking 18 years, the best correlation in the FX market has been risk on, risk off yen, right? Stocks go up, sell yen. Stocks go down, buy yen. Pretty easy. I mean, for the most part. I mean, obviously, there's more to it than that, but that's been like the most tried and true correlation in the FX market. That correlation is really in the process of breaking, and it has been for the last several months, since like the end of last year. So as it breaks and as we break away from that, what you're seeing like right now, stocks are hitting new lows. Dollar yen is not hitting new lows. We would have to be really aggressive, but you can see the stock market has been moving lower the last 30 minutes, and it's finally starting to take its toll on the dollar yen. But what that is also going to mean is when stocks bounce, the dollar yen's probably going to catch a bid. It's probably going to do one of these, so do one of those. So just think about that when you're dealing with the yen. These divergences and convergences, they work, and then they push and pull each other, because the market is so accustomed to seeing, oh, it's risk off. I got to sell some stocks here. And then, stocks are being sold. I need to sell some dollar yen here. And then what they find out is the stock market bounces, and then the dollar yen bounces a little bit more aggressively than the stock market. Okay. That correlation is not working as good as it used to. And that's just, a product of correlations changing their ways after 20 years of a pretty strong correlation. So anyway, just some things to think about as we head into today. It's a very quiet day today, and I'm going to suggest that you don't get too directional on a day like today. I know stocks look like they're grinding lower, but let's take a look at the equity markets really quick before I let Steve take over. So, here we are, nearing what I would consider pretty key support. All right, this is everybody's looking at this possible head and shoulder pattern. I thought I was being cute yesterday by identifying this, and somebody in our chat room goes, Blake, there's a lot of people looking at that head and shoulder pattern. And I'm like, well, the problem is that we're heading into a lot of support down here, right? We could actually drop maybe another 15, 20 points, break through this support, hit this trend line, get everybody tripped up on a fresh short, and in all actuality, we may end up just being in some sort of consolidation for the next week or whatever, right? So anyway, I'm just going to reiterate, don't try to get too directional here. I think the market's consolidating, yeah, so that's it. Steve? Stelios?
Nope, we're not here.
Sorry, you woke me up. What happened?
I know. It's definitely one of those.
It's a quiet day, man. Quiet.
It is very, very quiet, and it's that I'm trying to prevent people from getting too aggressive during these days like today. You know what I'm saying?
Yeah.
Mama told me there'd be days like this.
There would be. Mama told me too.
Yeah.
Steve, I actually opened my window this morning because the birds were out earlier, and we went from having 105-degree weather to 95-degree weather. So it's like still nice when it's dark outside. And the birds were here, but now they're not. I don't know where they went.
We could hear them until a few minutes ago.
Oh, okay. So you were listening to them. Okay, great.
Absolutely.
They wanted to know what you thought about the euro, buddy.
They heard my outlook on the euro, and they decided to get the hell out of town. So
no, they're just paying attention.
They're moving to Europe now.
Well, anyway,
they're migrating to Europe.
Yeah, right.
Bird flu.
So a pretty quiet session thus far. Stocks are a little heavier right now, but like I said, I'm not. I mean, I really think the stock market's down. It's one of those the bearish Trump comments with China. It's kind of probably freaked out a few people. But overall,
why? Most likely in a couple of hours we're going to get some kind of a statement like trade talks are progressing very nicely.
Yeah, I mean
something like that.
Something like that. Who knows? But but the fact of the matter is it's there's not a lot of direction here, and even though stocks are lower, what might be actually leading the market lower here is the DAX. The DAX actually getting beat up.
DAX actually testing key support as we speak.
What's that?
The DAX is testing key support.
Yeah, so this would be the neckline of a head and shoulder pattern right here. So somewhere around here.
And previous resistance, previous support. Yeah. It's a very key area.
Yeah, so I don't know if I'd be necessarily selling into this unless you were a seller the last couple of days. Again, I don't know if I'd be selling into all this, but anyway, just some food for thought. I think one of the things that might be dragging the U.S. indices slightly lower, but
I think just it's the obvious thing, Blake. People started realizing during the past few days that with the rebound that we had already seen, and with the economic environment being in a mess, risk reward made absolutely no sense being long at that levels, and especially that valuations, because we might not be at all-time highs, but valuations are at all-time highs because earning expectations have plummeted severely.
Yeah,
right. So, I do think the equity markets are a sell rally type of situation here, but I'm going to pose this question very similar to what I did with the euro. I think equities are going down. Is today going to be the day that they break lower? I don't know. I kind of doubt it, but that's me.
Pretty negative week, though.
You guys, good luck today. I'll see you during the daily roundup. I'll be here. And remember, if you guys haven't visited our webinar sponsor, Forest Park FX, make sure you do so. They're the ones that help make this possible. So, Steve, Stelios, Coach, passing it over to you guys.
Thank you, Blake.
I just want to remind everyone that you have to be a member to catch Blake's roundup mid-session, and what's cool about it is after face you could go in, and while he's giving you the update of the action of the day, you could ask him questions like a few hours from now after things have developed. So that's a pretty nice thing to be able to do, although you could do that in the chat room all day long as well.
Yeah, the chat room is very immediate. We're all there, we're chatting away, and talking about markets and trades, and obviously if it's quiet, we talk about cars and movies.
Yeah, women.
Yeah.
Although to be honest, we do have several women among our ranks.
Of course, okay, data. We have jobless claims out of the US. Let's look at those first.
Another 2.5 million expected.
Yes, so that takes the total to what, 35 or something like that?
I think close to 35, 34, something like that.
Okay, let's see. Yeah. Let's see, it's coming up now.
Oh, 3 million.
3 million. Okay, so it's worse than
another 3 million.
Canadian.
And the previous print was in essence confirmed that what it was. I mean, revised higher by 7,000, which is statistical error in essence.
Canadian data very bad. Manufacturing sales.
Yeah, manufacturing minus 9.2. A lot worse than the bad number already expected. Minus 5.7 was expectations. Ooh,
yeah.
So another 3 million unemployed. Yeah.
Yeah, it's well, it's not good. The big question remains: how quickly do these people go back into the workforce after, when the virus is controlled in some way? And
I think we're going to see a quick rebound in employment, Stelio. And I believe that the market is going to go optimistic initially. But when the market realizes that the quick rebound is nowhere close to taking us where we were before, then the reality will have to settle in.
Yep, that's quite likely. So okay, so worse numbers than expected. What else do we have data-wise? Very little, actually. We just had the Australian employment
36. Sorry, I had live squawks. That brings the total to 36.5 million.
Yep.
Unemployed within 8 weeks. So not even 2 months.
Yep. Yeah, that's sad numbers actually, but what can you do? What else? We had the Australian employment numbers for April, nearly 600,000 jobs lost, very close to estimates. So that was not really a market mover. Really, the only thing overnight and this morning has been some statements. First by Trump, just like Blake said. He did say that she and him have a good relationship, but right now I just don't want to speak to him. That reminds me a lot of my ex-wife. She didn't want to speak to me for a while.
But you had a great relationship.
No, but seriously, he said, he also talked about these events now with the virus, etc. Probably, he said that they probably signal the end of globalization, which is a pretty big thing to say in my opinion. I think he's partially right that things are going to get much more local.
Agree.
But the end of globalization, I'm not sure, the way he's saying it. And
there's definitely a trend change. That there's no question about it. Now, the world cannot go back to deglobalization as we meant it like 100 years ago. There's no question about it. No chance that can happen. But the trend has reversed. There is no question about it. And that definitely puts more weight to the global economy as a whole, right?
Yeah, absolutely. Okay, he actually did say a couple of other things which are worth mentioning. Dr. Anthony Fauci, the guy who talks about the virus in the US and how it's going, etc. He testified in Congress. When was it? Recently, anyway. And Donald Trump publicly basically said that try to make what Fauci said smaller than it is, because Fauci was quite negative. This thing could take a lot of time, and it could flare up again, etc., etc. And Trump actually said, he's trying to play all sides of the equation. That's what Trump said, word for word. And he said also that the information that they have on China and the virus is not good. So, there's a lot of war of words happening, especially from the US side. And I really don't know how this can be in any way non-destructive towards the US-China relationship. But, we'll see how that goes. As we know, the market and people have a very short memory. And, from one day to the next, they can say completely different things. And we just move on. So that's from the US side. We also had the chairman of the Bank of England, Bailey, talking about rates and talking about negative rates in particular. Remember, the Bank of England has been dismissing negative rates as an option.
So it's a certainty it's happening. That's what you want to say.
Yeah, perhaps.
Now that they've denied it, we know for a fact that it's happening. Yeah. Okay.
He did say that negative rates is not just an extrapolation, a linear move from plus 0.5% or 0.25% or zero down to minus 0.25, minus half. He said it's a very big step to actually go to negative territory, which kind of makes sense. I'm surprised he actually said that. He did say that they're not currently considering negative rates, but, and I quote, he said, it's always wise not to rule out anything forever. So, it's not out of the question. He did say that they don't see any evidence that inflation is about to spike, even with all the stimulus. So he's
as they've never seen any evidence that any economy is going in a recession, ever.
Well, the way they measure inflation is...
Yeah, of course.
Yeah. So, they're not ruling anything out. They're still against negative rates, but they're not ruling anything out. And knowing the Bank of England and the way they've been for the past years, I would take the under on rates there anytime. So if they say they're not going to negative...
Stelio, I think the next step is going to be, of course, the initial reaction from inflation is going to be lower due to the shock. There's no question. The very short-term reaction is going to be lower, but following that, it's going to be higher. So I'm wondering, do you think this is the time to have another Baskin committee? That was the name, right? If I remember right, in the 90s.
Yes.
Yeah, they formed the Baskin committee. I think it was during Clinton's era, because they had decided that the CPI was overstated by the statistical models they were using. So they wanted to, quote unquote, fix it.
Fix it lower.
So
always.
Something tells me that soon enough, after the initial shock to the economy, which the initial shock, of course, has deflationary repercussions, passes, something tells me that they will want to form another Baskin committee.
The Boskin Commission, there you go.
Yeah, Boskin Commission, whatever, yes.
Yeah.
So they'll want to form another Boskin Commission to fix the current CPI that they're probably going to figure out 10 different ways of how it overstates inflation.
Yeah. They've tinkered with it so many times.
Yeah.
They might do it again. Interestingly, I read a friend on Twitter writing something very interesting, and they said that I have a friend who has a company producing XYZ. I can't remember what it was in the UK, and transportation costs are going up a lot.
Of course.
So they have to increase their prices by a lot to compensate, to basically not to be able to make any
tangible product has transportation costs, right?
Exactly.
I mean, a service doesn't, but anything tangible you want to buy, it has to be transported from place A to place B, and sometimes, the initial the market that does the production to the end consumer might be thousands and thousands of miles away.
Yeah. So inflation is coming. If goods of prices, actual physical goods go up. Price of goods, physical goods go up. We're going to see inflation for sure. So it's. I think I agree with you. The initial shock or the initial reaction might be to see inflation go lower. We're seeing this already, but eventually, I think we're going to be quite a bit higher than where we were before. 1-2%, which was the standard for the UK.
Let's not forget, Stelio, that the CPI was constantly near 2.5% in the US. During the past, couple of years. I mean, it was 2.3, 2.4, and all that with the way it's being measured at the moment.
Well, the Americans, they prefer core PCE, right? Because it's lower. That was around 1.8. But I know what you mean. It was around there. And I think we're going to be going back and higher than that.
Yeah, for sure. Until, as I said, we fix again the way we measure the CPI to, to make sure it measures it even, worse than it does at the moment.
Equities are going lower, man.
Equities are, and they're currently testing actually a key support area. I'm going to show all that. So, Stelio, anything else before we jump on the charts?
No, my friend, that was it. It was a pretty quiet day today and last night.
Okay. Perfect.
Thanks,
so
Steve.
let's have a look at what's happening here. Blake already mentioned that the euro is once again testing support. Of course, that more or less would mean, and it's true, that the DXY is very, very close to resistance as well. You can see it here. So it's decision time for the DXY. I mean, up to 101, the risk reward would favor shorts in, in what would be maintaining the recent range, but above that, you can look for a squeeze higher. And of course, the fate of the DXY, since everything has now become again more or less a single trade is going to be decided by what happens with risk. Now, a brief outlook in the major stock indices. S&P trading below this channel, the Nasdaq trading below this channel, the IWM will be trading because it hasn't opened yet below this channel. The VIX has broken out from its equivalent descending channel, and also the last part of its price action was a descending wedge. We're breaking out of that as well. The DAX, as we showed earlier, testing key support after failing after one last push as we expected from that rectangle. The FTSE, as we expected, it has rolled over after breaking through this ascending wedge. The Nikkei, I think everybody can recognize what type of formation this is, and we're currently testing support. The IBEX, somebody asked a few days ago, and I said that, listen, it looks very bearish. This was like a pennant, right? And we seem to be breaking below it. So, I don't need to go through more indices, but let's have a look at Australian stock index. You can see same deal, breaking through a bearish pennant. So bottom line, there isn't a single index at the moment that looks constructive, at least not in the short term. Now, that doesn't mean that we're going to retrace all the way back to the lows. Under normal circumstances, we would have been a lot lower anyhow. But, given the fact that we have so much liquidity injected in the system, it makes sense that stocks have been completely ignoring economic and fundamental reality. But, there is so much as they can do about it. So, as I was saying, since a few weeks ago, valuations up where we were made absolutely no sense, and it would be very, very hard to sustain these levels. Now, downside areas, and I'm not going to go over every single index and point the downside areas of support because there are too many, but we're going to have a look at them on the S&P, which is the barometer for risk. The first clear area of support is 2720. You can see why here. I mean, we bottomed out in April there, and below that we have 2680 and 2630, 2640. My target actually is that in my short, 2630 to 2640. But 2720 is the first area of support. Greg indicated that as well, and I have no disagreement there. So pay close attention to that level first and see if we can get a reaction from there. As long as the indices will remain under pressure, the dollar is going to be doing quite well. So the question is, how low can risk assets move to see how high the dollar can go? The cable has already triggered this head and shoulders formation. Implied target would be at 118.80. Now there's another area of support I would be looking for at 120 first, but anyhow, the implied target for the head and shoulders formation is at 118.80. Euro USD, as we said, hasn't broken out yet, and another area you can see that is in the euro pound. The euro pound has rebounded and is toying around with the idea of breaking through this rectangle, which would imply an extension higher equal to the height of this range, which would take us to roughly 90 cents, 90.20. Now, Aussie, we know that Aussie and Kiwi once again have been, recorrelated very strongly with risk assets. So, continuation, Kiwi looks a lot worse, as you see. I mean, Kiwi Very nice ascending wedge, breaking down, already posted the lower low. So, that definitely has bearish implications, but even better if you have a look at the Aussie yen, got rejected once again from the 61.8% fib after backtesting the broken ascending wedge, and Kiwi yen, which is currently testing this triangle trendline support. All of them look vulnerable, right? So more weakness in stocks, which looks like a very high probability scenario, definitely has bearish implication for all these pairs. Steve, can you cover FTSE with equities again, please? Jane, yes, although I just did very briefly. FTSE has broken below this ascending wedge. You can see it's already crafting a lower low. I think the next area of support is at around 5,500 for the FTSE. Even if we assume that this is a corrective pullback, which is like the best case scenario, equality of the two legs would take us to 5,530. So that's what I think about the FTSE. We had already actually drawn this direction lower since a few days ago. That, and I had indicated with my charting, as you see, that 5,500 was a pivot area in essence to see if we're going to get more weakness toward the lows, or even, producing lower lows, or if that would be a corrective pullback. So, we're soon to find out, actually. Comments on USD CAD? Yes, absolutely. So USD CAD, let me find it first. There it is. USD CAD, unsurprisingly, is testing resistance. You can see it here. Needless to say that the breakout from this formation has quite bullish implications, with the first area of resistance being at 142.60, and above 142.60, in essence opening the door for a continuation all the way up to retest the previous high at 146.70. And the reason I'm saying this is because by breaking through this trend line, this is definitely a bullish development, but afterwards breaking through 142.60, we also trigger this rectangle that has a range that's extending from 138.50 to 142.60. So, that measures roughly 400 pips. Add those 400 pips to the upside, and you get a measured target of what we saw being the high back in March. I've been saying for a long time that if there is one pair, I would be more comfortable holding a USD long positions. That would be the USD CAD. So no objection from my side in seeing more strength there. In any case, can you analyze USD NOK? Yeah, I'm still short the USD NOK and the Euro NOK. Because I do think that long term the NOK has a lot of value, so I've actually started building a long-term position there. I only have 1/3 of exposure in both of them, and I'm going to be fine even if they move against me. Now, the USD NOK found support yesterday exactly at the 61.8 of this move higher, this explosive actually move higher. Its last leg higher was clearly explosive. There is a very high chance, in my opinion, that that was a blow off top, and we're not going to see higher levels from there. There is also a chance, I think it's not a high chance, but there is a chance that we might even see a higher high before lower. In any case, I think that a long-term position along the NOK is a very, very good long-term thesis and long-term trade. Now, of course, for the latter scenario to play out, which, as I said, I think has much lower chances, first we would need to see, at least the previous rebound high at roughly 1080 been taken out. So, I mean, against the 61.8 that we found the low yesterday, and we're trying to form a morning star formation on the daily here, if we close positively on the day, risk reward makes sense to be long, right? At least for a short-term trade. Personally, as I've said, I've started building a short position, and since I'm looking for this to be a long-term trade, I don't really care what it's going to do in the short term. But anyhow, in the shorter term, as I said, from a risk-reward perspective, you want to be long against yesterday's lows. I do understand the thesis behind it, and it makes sense. Okay. First area of resistance would be roughly at 1058, and then 1081, and then sky's the limit once again. Okay. Can I get your take on the Aussie Swiss? Yeah, absolutely. Listen, there is a problem with Swiss pairs, or you can see it as a blessing as well, and I'll tell you what it is. Last time we had a look at it was some time ago, as you see. So, the problem and the blessing. Let's go through both of them. With the Swiss franc being openly and admittedly manipulated from the SNB, and it seems to have found some type of an unofficial and artificial floor at 105. In essence, you can take positions in Swiss pairs by hoping that the Swiss component is not going to matter much. So, for example, you have a clear outlook about what you believe the Aussie is going to do, but you're not sure what the USD is going to do, or you're not sure what the yen is going to do. Perhaps you want to trade it against the Swiss franc to more or less remove the second component and trade purely on the Aussie. So you want to be bullish the Aussie, for example, being long the Aussie Swiss, is nice, especially if we get some, big risk rebound. Let's say that things start progressing a lot better than expected. Let's say the economies open up a lot faster than expected, and the rebound in employment is a lot better than expected, so on and so forth. You're going to end up benefiting from both components, because, for example, a pair like the Aussie Swiss is going to be gaining both because the Aussie is going to be getting stronger since it's risk sensitive, and because the Swiss might start depreciating, because the Swiss franc is the main beneficiary of risk-off flows, right? So if we assume that at some point the situation de-escalates and things start improving, you might see a nice rebound from the Euro Swiss, and you might see the Swiss franc depreciating across the board. Now, having said that, so far there is no such indication, and so far, and especially as long as we trade below 65 cents, I think that the risk reward is starting to be skewed against the Aussie Swiss, in which case a breakdown should lead to further losses. So that's what I think about it. Now, something like this is also a likely scenario. But, the closer we get to 65 cents, the more careful I would be. Aussie actually was quite strong or less weak today after bad job Aussie. Yeah, the Aussie in general has performed decently lately, partially because the risk assets have been performing better. It was also, very oversold, admittedly. EURUSD heading for weekly support at 104, in my humble opinion. Says Ingmar, breakdown will open the door to 96 cents by late 2020. I'm very skeptical about the EURUSD going below parity. I have to openly say that once again. I'm not saying it's impossible. It's not impossible at all, right? Now, on the other hand, there is no question about it. The EURUSD has been in a downtrend since February 2018. But unless I see a break below 1075, I would be very careful here, because the risk reward is, against this area of support, favors only long positions. Now, I'm not saying that the chances are it's going to move higher. I'm saying that against support, you either are neutral, or you're hoping for another rebound from the same area and you're long. Now, if we do break through 1075, I think that the move towards 105 can happen, rather quickly. No disagreement there. EG heads higher when Euro USD falls more frequently than not, says Gautam. Yeah, and Euro Pound definitely testing resistance, and Euro Pound definitely breaking through that resistance, has a very high chance of extending higher. So the same one calling for DXY 70, calling Euro USD to 96 cents. Who did that, especially at the time you wrote that, FX Trader? And in any case, I don't know who you were referring to. Probably Dale, judging from the time, because Dale had only spoken until that point.
No, not me.
Yeah, but that comment was written 7 minutes after the webinar started, Dale. So I don't know what he thinks you said, because
I only talked for 5 minutes today.
Okay.
He's got something. Is it FX Trader?
Yeah.
Okay, well then, I rest my case.
Quick question about the USD, question/comment about the USD yen. Listen, the USD yen is still trapped in this triangle. It has posted several false breakouts. Now, you want to go in lower time frame, and I talked about that the day before yesterday when I replaced Blake in the daily roundup, and I had said the exact following thing. That's a webinar only for our subscribers, by the way. I said that this looks like a flag to me, and I wouldn't be surprised to see a break higher. We moved a little bit lower. We seem to be finding support here at 106.75, and we seem to be breaking above this. Now, this has even more value considering the fact that stocks are moving lower. Despite that, the USD yen seems to be holding up here. So yeah, I do see that the risk reward in the short term is skewed towards being long, but as I've said a long time ago about the Euro USD and about the USD yen, and I think I've got vindicated in essence by what has happened, I would rather put my money to work elsewhere, because so many people are trying to guess what direction these pairs are going to take, and for so long, in essence, they haven't been doing anything. So I would rather be trading things that are moving than things that are attempting several times to move, but in essence, they remain trapped in rather tight formations. So that's my, at least for my trading style, I'm mostly a swing trader. I'm definitely not a scalper. That's how I think about it. Hi, what about USD TRY and Euro TRY? Turkish lira has been bouncing since last week. Yeah, that is actually true. The USD Turkish lira did produce a new all-time high before playing out nicely with this RSI divergence that we had and this ascending wedge and moving lower. Now, I'm going to tell you two things here. First of all, yes, that makes short positions against the highs, especially if we see any type of rebound towards 706, rather appealing, especially for a move towards the previous area of support at 680. But, you have to keep this picture in mind. Just look at this. I mean, the Turkish lira depreciation is a multi-year, I mean, it's been going on for like 12 years, thing that's non-stop. So bottom line, whenever you take the short side, which as I said, it makes sense now from a risk reward perspective, especially given that reversal, you have to be very nimble, because the Turkish lira has lost something like 80% of its value, 85% of its value during the past 12 years, and for a very good reason. Okay, so, keep that in mind. Long gold at current levels, Blake. Okay, so that was obviously for Blake when he was talking, but I have no problem having a look at gold and telling you that nothing has changed since yesterday, the day before yesterday, etc. Meaning we're still trapped in this triangle. As long as this is a triangle, I still favor a breakout to the upside from here, with upside resistances being at 1771 and 1821. Silver, definitely not any real bullish momentum, but that doesn't change the fact that we've broken above a triangle and it remains rather well bid, despite the fact that the US dollar is holding up quite nicely. So I think quite dangerous trying to fade them. Cable to lead Euro USD lower on a bridge of 121.60. Yeah, I do agree that the two of them cannot keep diverging for much longer. So yeah, if the cable keeps moving towards 120, the euro will eventually have to break through this 1.075 area of support. I'm with you there. I mean, they can't. I mean, they can keep having a difference in how much they react to US dollar strength, but moving in opposite directions, for example, no, that's not going to be happening. Okay, DAX is also retesting December 2018 lows right now. Critical support at 10,017. Listen, I said it before, the DAX is at key support. You can see it here, this 10,250 is a key area of support. Below that, I think that in essence, there is no serious area of support until we move all the way down to 9,200. Flying the fumes of the Fed. Yeah, hi Steve. I know you don't like trading Euro USD now, but could you please have a look at the pair? Yeah, Dimitri, we already talked about it. As I said, I wouldn't be short against 1.075, but below 1.075, I think Euro USD can move rather quickly to 1.05. Thank you, sir. Can I get a chance to join the chat room? The chat room is available for any premium subscriber of ForexAnalytix. Every time the same bad news and dollar thriving. Yep. So far, this is the correlation, unquestionably. Oh, Dale, do we have an interview? I just looked at the time.
Yeah, I played an E chord.
Really? I didn't hear it.
Okay, I'll play it louder next time. Yes, David Keller is with us.
Okay, perfect. Anyhow, I think I covered...
Chief Market Strategist at StockCharts.com.
Okay, perfect. Anyhow, I think I covered like 95% of the questions. We're going to be here again tomorrow. So, whatever other questions, we'll talk about them then. Enjoy the interview, Dale.
All right. Thank you very much. Okay, David, I'm going to get you set up now. Welcome back. And I'm unmuting you. And welcome back to Face, David. How are you?
I'm well, Dale. Thanks for having me back. Good to see you.
It's great to have you. Just for people who don't know you, and Joe Perry said you're one of his favorites. Okay, so Joe, and David is Chief Market Strategist at StockCharts.com, President at Sierra Alpha Research, and also has his own website, marketmisbehavior.com. Oh, come on, David. The markets never misbehave. In fact, I wanted to ask you, for me, trading this pandemic has been even a little bit more challenging than the last one.
Dale, why don't we get him to share his screen first?
Yeah. So you look for the, David, you just look for the green button. It's coming up now.
Perfect.
Beautiful. Okay.
You see it okay?
Yeah. Okay.
Perfect.
We got it. So, David, last time we talked was before the virus popped, was a pin to pop the bubble, one of the most dramatic declines that I've seen in my trading career. And the big question is, after this decline, do you think that we bottomed and now we're just going to correct the correction? or could a full-blown retest like people like Gunlet are talking about, could that happen? Where's your head at?
So, I mean, what we have to remember, I mean, I know so many have talked about how this sell-off and the subsequent rally has been unprecedented. And by most measures, that's absolutely right. What we have seen plenty of times historically is a dramatic sell-off, you know, and having a market lose 30%. We've just never seen it really this quickly coming off of a new all-time high. And then we've seen V-bottoms before. We've seen markets, you know, come very strong out of a depressed point. We've just never seen it happen this quickly and turn this quickly out of the lows. And again, we've seen the price movements, just not the time compression that I think we're seeing. So to your point, Dale, I think in many ways, the time factor of what we're seeing here is what's very unprecedented. What is pretty classic is the bear market evolution, which is a big sell-off from, you know, in a seemingly, you know, a precipice that it feels like we're never going to come down from, that we come down suddenly. That has happened many times before. And a subsequent rally that retraces about 50 to 61.8% of that move. That's actually pretty classic. And if you look back through historical bear markets, that's kind of what they tend to look like. And we call this and what I would label this is a bear market rally. This is a rally that sucks so many investors in. And the really, you know, fortunate investors are the ones that bought here in, you know, the last week in March or first week in April. And then everyone else are the people that have sort of caught in later and are fueled by that fear of missing out of it, returning to S&P 3,400 or something like that.
Right. And I saw charts, David, that when we were up there before this recent sell-off, that growth was back at all-time highs. Growth stocks were back at all-time highs. So, you know, people talking about valuations with what's going to happen on the PE made sense. I see a lot of gaps. I know you're a technician. You know, and some people are talking about during this correction that we could get down towards that 25.5 gap. You think that is viable, or, you know, the question is, are we just going to correct the correction and then surpass 61.8, or are we looking at this as the end of the bear market rally, as you were saying, and new lows are coming? And how deep could it be if that's the case?
So I would say this, you know, my short answer is I think we're going lower. I think, you know, hitting 61.8% makes a lot of sense from a technical perspective. We've now retested it. The S&P's put in a bit of a lower high there in the last couple of days. And for me, when you're thinking about the tactical time frame, it's all about the peaks and valleys. And we've now, you know, set a lower high. We are very close to setting a lower low. You know, we have to go a little bit below 2,800 today, and that sort of satisfies the short-term downtrend. The other reason why I don't think we're going to go much higher than this is if you look at the RSI, it's peaked out right around 60, almost exactly at 60 the last week in April. And in a bull market phase, the whole range of momentum kind of bumps up. So when the market pulls back, it pulls back to around 40 or so, and then it'll become overbought on the upswings. On a downswing, the RSI will become oversold, and it'll never really get above 60. So the whole range has bumped down a little bit. So that is what gives me a lot of confidence that I think we're at that. I think we've hit the ceiling, at least for the foreseeable future. The other chart I would maybe show you to validate that is the cumulative advanced decline lines. And I'm sorry for jumping around with the charts. But
that's okay.
Hopefully you can see this. So this is looking at the S&P 500, and then I'm looking at the cumulative advanced decline lines for the S&P 500, the New York Stock Exchange, the mid-cap index, the small-cap index. If you look, all four of those have been in this nice short-term uptrend, higher highs, higher lows. Everything's fine. This is coming out of the March lows. All four of them now, as of yesterday, have now broken down through trendline support. So we have this rotation. They've now put in lower highs. They're now putting in a lower low. And so even though the S&P hasn't broken down yet, breadth has actually broken down for a lot of these. And I think that's because people have gone to the safe havens of mega cap stocks, Microsoft, Amazon type of names that will keep the S&P elevated while the average stock has already started to rotate down a little bit.
So tactically, David, how do you take advantage of a bear market? I mean, a lot of people haven't even seen one that came into this business. You and I have seen a couple. You know, it was a joke that I was here for the last pandemic, but really, you know, a lot of people came in after 08, after the 08 lows, or they weren't here for the dot-com bubble. You know, they've seen, you know, every pullback since then just be a great buying opportunity. How do people learn to tactically take advantage of a bear market? What are you telling people? Is it just capital preservation, or is it an opportunity to play the downside for you?
Such a great question. And I think you hit on a perfect point, Dale, which is the beauty of the infrequency of bear markets, but the regular nature of them is that every 5 to 10 years, there's another one that gets a whole new group of investors, that have never experienced one, to sort of experience one firsthand. And so how do you play something like this with potential downside? To me, I think it depends on how long your runway is. So if you think about it, if you're in a retirement account and you're planning for the next 20 to 30 years, I would argue the market comes down, it's going to be the buying opportunity of your lifetime to be buying stocks as they're super depressed relative to where they've been not too long ago. If your runway is short and you're trying to play this more tactically, I think you have to be watching the tactical trends that I was pointing out, so the short-term fluctuations, and looking at breakdowns of some of these key levels, which I think we're just starting to see the beginning of. And then I think, what do you do in terms of capital preservation? I think you're right. I think, everyone has some equity allocation usually. So the question is, where can you park money within stocks? And so it's usually looking for income, looking for high yielding places, utilities, real estate, some staples, for example, which are scary because the price is going down, and you're right. But what you need to do is focus on the relative strength. And so for me, you're looking at stocks that have been able to weather uptrends and downtrends. Microsoft is one that comes to mind.
Yeah.
Even as the market rallied, Microsoft started to outperform. As the market sold off into mid-March, the relative strength continued to go up. As the market recovered, it's continued to go up. So a lot of things in tech, if you look at the chart of the XLK, it's sort of a similar picture. It is outperformed in bull phases and bear phases. So I think you want to be in places that are outperforming, and so focus on the relative strength line, maybe more than you normally would, to find stocks that are able to outperform. And then you focus on the income component. Look for stocks, and especially in this environment where companies have been cutting dividends, look for like the dividend aristocrat type of names that have demonstrated their ability to keep a dividend through a lot of different previous cycles, previous downturns, and bet on that consistency, which is going to give you a consistent income above any other sort of product at this point, to be honest with you, relative to interest rates and elsewhere.
What's your view on taking positions in bearish ETFs, and especially the 2-3 times ones? That I know there is erosion in those instruments where, say for example, the underlying index may not make a new low, but they do because of the costs of the fund. So I've seen that type of it's almost like decay. Do you have a view on trading this stuff and having a piece of your portfolio? And is there a way in this rally, say people are long term in their IRA, for them to hedge for what could be another wave to the downside?
Yeah, that's a really good question. I'm glad you asked that. And so I think that's one of the really interesting, when you talk about what makes this sell-off, makes this bear market experience a little different. And in each one of the last bear markets you mentioned, the tech bubble, the financial crisis, there were some structural differences that caused it to be unique. And I think the one now is you have a lot of ETFs, especially those leveraged ETFs, that have not been battle tested in a bear market environment. They haven't been tested with the amount of flows we're likely seeing, with structurally what happens if a commodity goes below zero. What does that do to an ETF that's plugged off of it? Like we can figure out theoretically what's going to happen, but that's a new experience for investors holding it, and that's what I think is going to impact people. With something like, I'm bringing up the SDS here, and to your point, the SDS went from, it went up from, low 20s to mid 40s. And this was a huge, 80+% gain, very, very quickly over a 4-week period. It's retraced 100% of its way back down to zero, even though the S&P only retraced 61.8% of that.
Yeah. So that's very big decay.
What you have to remember is, anything that's leveraged, it's based on the daily percent moves. And so you think you're making an inverse bet to the market, but you're not exactly doing that. You're doing that on one day. But once you string a couple days together, you're becoming more and more disconnected from the actual trend of the market. So I think you have to be really careful about holding these for the long term, which they really weren't intended to do. you still could. And I think if you think the market's going to crater from here, buying the SDS, I think you could make an argument for it. I think overall you'll probably do okay with that. But just remember the exposure. I think a lot of people just need to be very familiar with what exposure you're actually getting.
Oh yeah, I made that mistake, David. I admit it. I did it with TVIX and sure. lived through reverse splits into oblivion. So yeah, that's why I bring it up. A lot of people think, just like I thought, that I'm just making an inverse bet, and then they're wondering why they're not performing or underperforming the underlying asset. So definitely know what you're doing before you click your mouse.
That's exactly right. And that's where I think, honestly, everyone viewing, I'm sure, is in tune with charts to some degree because they're using your platform and they're familiar with it. But I think this is where charts can have a great advantage. Don't just think, all right, I'm getting a double short S&P exposure. Great. Look at the chart and see what's actually happened over time, and look at what the performance has been, and understand. You start to make assumptions about if X, Y, Z happens in the markets, what is that going to do to this product? And just make sure. And I think the same thing with costs. There are a lot of costs baked into a lot of these products that people are not aware of in terms of the spreads on some of the ETFs that are wider than you would get in a stock, which are essentially zero now. So, look at liquidity, look at your ability to get in and out of things, and just look at the exposure you're getting.
David, a lot of people through the previous two crises, most investment advisors or brokers at major firms had a formula: certain percentage stocks, certain percentage bonds, certain percentage cash. After what happened to the bond market when it got locked up, and say TLT traded 180 and now it broke to 140, does that put into question the fact that the bonds may or may not have the same type of benefit of being a hedge during market declines? Because if the Fed had not stepped into the corporate bond market, people were not able to finance it all. And do you think that the Fed has solved this credit crisis with these unusual steps?
And again, I think the future is going to tell us whether or not it's working. And I think that's the thing that's difficult about this environment. It's certainly the uncertainty of how some of these steps are going to actually work out are unknown. I think the unintended consequences is what we don't know yet, and that's what's going to come out later. In general, though, I think a lot of people make the mistake of making a simple comparison. If stocks are going down, I should go to a safe haven like bonds or gold or something like that. And for every time you show me where stocks go down and gold goes up, I will show you another time where stocks and gold go down together, where stocks and gold go up together. Because you have to remember, it's not like there are two securities, stocks and bonds, and people allocate to one or the other. It's not a zero-sum game. There are a lot of influences. As you mentioned, the Fed can create a lot of artificial supply and demand to change the picture. And as a result, I think, again, a focus on the charts is what can be really, really helpful, because you can understand what's actually happening. You had mentioned, I think, this round trip with the TLT. And I've been doing this for a while. I mean, even going back to the Volcker days, where you had rates spiking to the upside. I've never seen what's supposed to be a conservative market have that kind of range within a week. Yes. Yeah, this is a new one, and I think there you could see this disconnection from reality that felt like a lot of things happened in mid-March, and arguably that sort of corrected. And again, I think going back to your early questions about the market direction, I think what concerns me about this is it's not just the Fed's actions that cause the prices to do a certain thing. I would argue that is relatively minimal. It's people's expectations of what the Fed actions are actually going to be able to do. And the reason why the market can recover so quickly is because they believe that the Fed can step in and buy high yield ETFs and do whatever they need to buoy the markets as they want, and they have the ability to move prices up. But what happens if the Fed continues to take that action and every investor on earth stops believing that they have the ability to do it? even with that Fed buying, the market's going to start going down because the panic that's going to come from investors not believing it, the disbelief is going to outweigh anything that the Fed can do for a sustained period of time. So I think the what we're betting on right now is that people will assume the Fed can come in and provide support and make markets do a certain thing. Once we, as a collective group of investors, don't believe that as much, I think that's when the market can go down in a meaningful way again, and maybe create the next leg down. It's that disbelief that's going to do it. But I would point out with bonds, the other thing is I would caution everyone. We often, one of the phrases I've always loved to say, don't confuse the bottom of the page with support. So when the 10-year yields are going down and you say, all right, well, they've gone down X%, they can't go much lower than that. A lot of people were saying that all along the way back here. Yeah. And I know when yields broke below the low in 2016, a lot of people were saying, all right, well, the market can't go down much more. I mean, yields can't go down much more than that. And surprise, they actually can go a lot further down, and they can even go below zero, right, theoretically. And so I think just because something hasn't happened before or happened recently doesn't mean it can't happen. And so bond prices can certainly go higher from here. At some point, yields get so low, it starts to seem unreasonable, but it can happen. So again, I focus a lot on the trends and what the charts are telling me. And if the stock trend starts rolling over, and if the TLT finds support at its 50-day, I could justify owning the TLT and not owning stocks and feeling pretty comfortable with that for a little while, for sure.
Okay, so what I've noticed, if you look at LQD and junk, that with the Fed in it, David, actually they've outperformed sovereigns. So could it be there's junk, maybe junk isn't, but the LQD almost made new highs. I'm wondering if what the Fed is doing to prop up the private sector is at the expense of sovereigns. And also, politics can play a role. And I'm wondering what your thoughts may be when President Trump talked about canceling debt with China on the bonds and, deteriorating. I know people that say we're already in a Cold War. It sure wouldn't take much, just a little bit of selling by the Chinese to cause a panic in the bond market, don't you think?
That's absolutely right. And I think that's where I think the uncertainty is the artificial buying and selling that can come in. When we're looking at sort of the bear market playbook and historical market downturns, there has always been, there have always been some sort of structural events that have been part of it, right? So the 87 crash, portfolio insurance caused all sorts of issues, and with the financial crisis, the things that have been put in place afterwards have changed the structure of the market enough that we don't know what a bear market exactly is going to look like, but we do know that human behavior is universal, and people's ability to be optimistic or pessimistic with their investments is what's really going to cause things to move. Having said that, we're in this period where you can have news headlines and expectations change so quickly with dramatic impact on the markets. And I think that's what we've seen over the last couple months now. Dramatic sell-offs that are met with dramatic rallies and volatility in the bond market that we've not seen really ever since I've been following things. And so I think, could that happen? Could bond prices go down dramatically? Absolutely. I think where investors get into trouble is where they start to bake in the probability of something like that happening and then use that as the way to position themselves, because it's such an unknown. I think what you should do is think about, all right, there's this potential that this event could happen, which would most likely cause bond prices to go down. Look at the charts. At what point would bond prices hit? What would they hit? What would the TLT or the LQD or whatever hit? At what point I need to just cut out of it?
Or am I wrong?
The trend is down. Yeah, and it doesn't matter.
You have to know that before you go in. You don't go in and then try and find people that'll rationalize your position.
Yes.
Don't you think that most of your best strategies are laid out on the kitchen table over the weekend before market activity even begins, so that you can execute rather than analyze on the fly?
That's exactly right. And I've taught technical analysis and behavioral finance at the college level. And what I would always tell my students is you have earned once you answer these questions about the chart, Dow theory, moving averages, all these things. You have now earned the right to tell me whether or not you would buy or sell, or whether you're bullish or bearish. But the way you earn the right to actually take a position is you tell me what your exit strategy is, and you lay it out right ahead of time. I'm buying here. This is where I was wrong, and I get out. And so I think if you have that in place, I think the future is very uncertain right now. The market direction is uncertain, but that shouldn't bother you as an investor if you already have your plan laid out. When this XYZ happens, I'm going to take this action. If you can automate that as much as possible, do it. And then you're not, because otherwise you're making an emotional reaction as you hit on. You're doing confirmation bias, which is I'm bearish, and now I'm going to try to find as much information as possible to validate that bearish thesis, which is not the way to make money over the long term.
I had a college professor. I wish it would have been you, but the question was, David, what's worse, ignorance or apathy? And my answer was, I don't know, and I don't care. So I aced it. So I want to get to one more asset class. We have time for it, David. Are you a believer in this gold mining breakout to the upside?
I mean, gold, if you look at the chart of gold, I mean, overall, if you're looking at different asset classes and looking for something that's set up in a pretty positive configuration with, I think, potential for a lot further upside, gold, I'd be hard pressed to find one better than gold, to be honest with you. Okay. Even given all of this volatility, even given all of the uncertainty, the GLD has pretty consistently outperformed with periods of underperformance, but overall the relative strength seems to just keep continuing. There are very few asset classes that are going higher above 2 upward sloping moving averages. Gold's doing it. We have a ranking of all of the different stock universes. So we have a ranking called the Scooter ranking of all the large cap stocks from 99th to 1st percentile based on their trend profile. Newmont Mining has been pretty consistently one of the top 1 or 2 or 3 names for the last couple months, with good reason. I mean, it's consistently demonstrated higher highs and higher lows at a time when most stocks have not, and it's continued to outperform. And the outperformance has been pretty fantastic. It's outperformed the S&P by almost 75-80% year to date, which isn't bad. That's not bad for equities.
Let me ask you this, though, David. I have noticed that, or I was reading that flows into GLD are at record levels. Assets under management are at record levels. Is that any kind of sign that it might be getting crowded?
So that's the concern, right? I mean, and I think you're right. One of the challenges with commodity ETFs, or one of the maybe untested parts of them, is what happens when flows are extreme, inflows and or outflows, and what happens to them. Still, I think there is such, for especially institutional investors, there is an apathy, if you will, for gold. And I, with my time at Fidelity, would talk to the portfolio managers about owning gold in their portfolios, and they would say they could never go to an institutional client and justify owning gold in an equity portfolio. They just can't do it. So a lot of funds won't ever go there, and as a result, I feel like there's opportunity to for that to be a much further upside, even though there's been plenty of flows in there already. And I think it goes back to when something becomes overbought, and the chart of gold is actually a great example of that. People tend to think when something's overbought, when there have been extreme inflows, extreme demand, or lack of supply, that's a bad thing. Overbought is bad. But in the chart of gold, you can see overbought conditions, especially extremely overbought conditions, when the RSI gets above 80, that actually ends up overall being a good thing, because there's such extreme momentum, there's such buying interest that it's probably going to have further upside. Where you start to get concerned is when the price keeps going up and all of a sudden the momentum wanes, right? Well,
look to the right-hand side of your chart. Isn't that what's happening right here?
So what's different now is that prices are actually coming down, which is what's interesting, right? So if you look here, you've had, from the March peak to the April peak, you have this potential divergence with the RSI in February and the lower RSI in April. If that's what you're talking about, I think you're right. And I think that's the one danger side on my view of gold, is this one big divergence on the weekly chart. It probably jumps out even further. But again, what invalidates that is the price making new highs. So the GLD closing above 163, sort of getting to a new closing high, sort of pushes.
Yeah, I think it's going to happen. It's knocking on the door, buddy. I'd like to ask you a question, one host to another, and that you host different interviews on stockcharts.com, and I happen to have noticed something. I get the weekly email, and I recommend other people get the email and check out stockcharts.com. But, you know, don't you feel the same way as me that what an advantage to be like today, me having the chance to pick your brain as part of intelligence gathering? Because I did see a piece on stockcharts.com near the end of March by someone from my generation. I don't know, you're not as old as me, David, but Larry Williams saying I'm buying stocks here, and that was right near the low. So do you with your position and overseeing all the different, and you guys have some of the masters are contributors to stockcharts.com, doesn't that make you a better investor, trader, having the ability to gather intelligence from other people that you respect in the industry?
I mean, I would hope it's a great advantage. And I think what, your ability to talk about this, current environment and bringing all of your experience to bear of previous bearish cycles that you've been in, I think is fantastic. And, what I've always coached newer investors to do is learn as much from people that have come before you, because as much as the market is different structurally, there are so many consistent themes because the human behavior element is consistent. And even though structures are different, the way we make bets are different, human behavior is universal and consistent, and the fear that motivates investors is consistent. So yeah, talking with guys like John Murphy and Martin Pring and Larry Williams and asking them questions about what did this feel like, and even again from my time at Fidelity, asking Peter Lynch and Bruce Johnstone, what did 1974 feel like, and how did you, Walter Deemer comes to mind, who ran the technical team at Putnam in the 1970s. What was the 1974 low like? How did that feel? What was the, how nervous were people at the bottom? What did the 83 breakout when the Dow finally broke 1,000? What was that like? And so I think the as much as you can ask questions of people that have been through some of these pivotal moments, I think is fantastic. And, again, it's great to learn your own lessons by putting your own capital at risk. And there's no substitute for that. And every great investor I've met has had a story of climactic loss from earlier in their career, and that's a formative lesson for them. But I always remind newer investors, learn lessons from others where it's not your capital loss first, and try to gain what you can from them, and equip yourself to minimize the pain from some of those early lessons. And that's how you're going to become a better investor for the long term. But I think you're right. I think we're very fortunate to be able to tap the brains of you and many others.
And you just did that today here, David, for 30 minutes, edifying our community here in FACE and sharing your views. So the best way for people to follow you and stay in touch with you, your Twitter handle @DKellerCMT, is that correct?
That's absolutely right. And on stockcharts.com, I host the daily closing bell show on Stock Charts TV called the Final Bar. So yeah, check it out. You
TV star, you. Thank you so much, my trading warrior brother, David Keller. Cheers. Everybody.
Cheers, Dale. Be well. Thanks again.
All right, buddy. Thank you, David Keller. And that's a wrap for us. We'll see everyone tomorrow. Remember, don't just count your pips, count your blessings. You're welcome. David, if you're still here, you're getting some great comments. Someone said, I can't be here for the full interview, but I know it's an excellent presentation. I want to watch a video later. So much appreciation from the audience today. Thank you, David. And adios, everybody.